Hi everyone, my name is Mike Kelly and I'm a tax supervisor here at Kirkering Barbario. Today, my colleague Zachary Burzak and I will be discussing how the recently passed One Big Beautiful Act, or what we like to call OB3A, impacts the state and local tax landscape and what that can mean for your business. Before we get started, it's important to note that this bill is going to continue to evolve as time goes on, and we will be sure to provide you guys with updates as we get them. With the passage of OB3A, several significant changes are taking effect that may influence both individual and business tax planning strategies. Before diving into the state and local aspects of the bill, it's important to recognize that while OB3A introduced significant changes at the federal level, not all of these changes are going to automatically apply at the state level. Let's take the proposed deductions for tips and overtime pay, for example. Just because there's a deduction at the federal level does not necessarily mean it's automatically available at the state level. There can be several situations where the state requires modifications, and those deductions might actually get added back to your federal income. Whether a specific OB3A provision is incorporated into a state's individual corporate income tax code depends on a two-part test. Test number one, and it's more of a question, is, does the state code actually incorporate the federal provision? Even if a state conforms to the IRC, not all provisions are automatically adopted. Each state has its own statutes, and they can decide whether they want to fully conform to the federal provisions. They can partially conform, which, for example, they can decouple from certain provisions that might be in a certain section of the code, and then they can actually decouple altogether. There's several states, for example, they come about afterwards and they start to pick and choose what they'd like to conform to. And we'll get into that a little bit later. So test number two. So what type of IRC conformity does the state use? Even if a state tax code would incorporate the provision, whether the federal change is currently effective in the state depends on the type of conformity. And conformity, we kind of split into two sections here. You have what's called rolling conformity, which means that the state automatically adopts the changes to the IRC as they happen, right? The federal provisions from OB3A would obviously immediately be reflected in the state tax law, right? For any states that have this type of rolling conformity. And the next type of conformity we have is what's called static or fixed date conformity. This is when the state conforms to the IRC as of a specific date. For example, January 1, 2024, right? So this would mean that any federal changes made after that date, including the OB3A provisions, would not automatically apply in the state unless they had updated their conformity date, right? Now, some states, they update this annually. We've seen several states that lag by several years. And now I think Zach's going to go ahead and shift gears and get us talking about some of the state and local tax specifics of OB3A.
Hi, everyone. My name is Zachary Burzak, and I am also a tax supervisor in the general tax team at KB. So, what I'm going to talk about today are the kind of the headline provisions. One of the big items that came from the OB3A was a temporary increase to the state and local tax deduction cap. We'll call it the SALT cap for short. So, you may recall from the Tax Cuts and Jobs Act of 2017 that they lowered the SALT cap to $10,000. What this included were state and local income taxes as well as your property taxes that you'd be able to essentially deduct on Schedule A of your 1040. So what the OB3A did was it increased temporarily this cap from $10,000 to $40,000. And this is for the tax years of 2025 through 2029. So after 2029, the SALT cap is going to return to that $10,000 mark unless, there's further legislation to increase it. So one of the things to note is that there's an income-based phase-out for taxpayers with their modified adjusted gross income, or MAGI, over $5,000. So what this does is it phases out by 30% of the MAGI that exceeds 500,000, but you can't go below 10,000. So you're going to be able to get that $10,000 deduction. However, if you make more than 500,000 for your MAGI, it reduces, but not below 10. So another thing is that the $40,000 cap is going to be adjusted annually for inflation from 25 to 29. It's about 1% each year. So in terms of, what are the effects that are going to come about from this increased SALT cap? Well, if you live in a high tax state, individuals, that have higher incomes and higher property taxes, they're going to benefit from this because they're going to have more state income tax, higher property taxes. There's also going to be a potential shift towards more taxpayers itemizing their deductions as opposed to taking the standard deduction. So this higher cap leads to more taxpayers, specifically in those high tax jurisdictions, itemizing instead of taking that standard. One thing, even with the increased salt cap, we have the pass-through entity taxes or PTETs. They're going to continue to offer some strategic benefits, particularly through, pass-through business owners in those high tax states. So this kind of leads us into that section, which Mike's going to talk about now about those pass-through entity taxes.
Alrighty. And now we're going to jump into what is the continued role of the pass-through entity taxes under the new OB3A. So since the introduction of the SALT cap back in 2017, which was the $10,000 that you were allowed to deduct on Schedule A, many states have adopted what's called a pass-through entity tax, PTET for short. This kind of acted as a workaround for the states. So since individuals were being capped at the $10,000 at the personal level, states said, okay, well, what if we can find a way for your pass-through business, S corps, partnerships, to deduct the tax at the entity level to avoid being capped out at the personal level? So doing so, this obviously enabled the entity to claim a full federal deduction for state taxes, thereby avoiding the individual SALT cap limitation of $10,000. While earlier versions of the OB3A proposed limiting or eliminating this benefit altogether, the final legislation preserves the PTET deductibility in full, which means, pass-through entities can continue to elect into their state's PTET program and deduct those taxes federally. Where we were a little unclear was before we knew it was going to be a $40,000 SALT cap moving forward, we weren't sure whether these PTETs were going to continue to be as popular as they are now. Because obviously, if this cap went up to, for example, $100,000, maybe, these PTETs become a little more irrelevant. But I think with the cap staying, around that $40,000 mark, obviously adjusted 1% per year, I think there's still going to be a lot of benefit here from these pass-through entity taxes. I mean, especially in your states with high real estate taxes and some of your business owners that maybe have very profitable businesses and operate in multi-state scenarios. But basically, so I mean, while this temporary SALT cap obviously increased the meaningful tax relief, especially in the high tax states, these pass-through entity taxes are going to remain, an important and viable planning tool. However, the decision to elect into your PTET regime is not a one-size-fits-all. It requires a lot of thoughtful case-by-case analysis. Yeah, and I guess, Zach, you want to go ahead and close us out?
So if you have any questions around the SALT cap increase or the pass-through entity tax, please contact your KB representative or Mike and myself on the SALT team. You can also visit our website for a full list of resources related to the One Big Beautiful Bill Act at kbgrp.com.